quick increase in interest rates we've seen since the start of the year. We're up well over 50 basis points. What's been the general driver of that increase? We can dig into the specifics.
The biggest driver here was shifting from a reopening theme narrative within the markets to now seeing signs of a reflationary theme. And also with our bull case scenario coming more into view, the 1.21 gigawatts of money at 10:04 p.m., that also implies much faster economic growth than was originally expected. Basically, going all the way back till September, October, the market, especially the bond market, has really underpriced the potential for a V-shaped economic recovery, especially given how much money has been injected into the system and how strong consumer balance sheets were throughout COVID-19. And we think a lot of this now starting to really see the vaccine work and seeing successful case studies like what's going on in Israel right now. I think the market is very rapidly starting to price in faster economic growth and more of a reflationary type theme. And what that looked like in the bond market is what you see on this slide, where, at the end of 2020, that blue line is your treasury yield curve. And then 2 months later, you see the 10-year treasury yield, for example, 50 basis points higher, 0.5% higher. And at times during February, actually got up to 1.61%. So that's a pretty big jump, especially considering how low yields were. That's right. A meaningful move.
In terms of how maybe Janet Yellen and or even the Biden administration would think about the rising interest rates, what actions would they be concerned with?
So if it got to the point where longer term interest rates rose so significantly that the Treasury, in order to finance growing fiscal deficits, felt like they had to do it in shorter and shorter maturities, that could become an issue. So ideally, if you're going to spend $1.9 trillion and then another $1+ trillion on infrastructure, you would like to do it at very low rates and over very long maturities. But if we have a rapid spike in Treasury yields, then the numbers don't make as much sense. Not that they make sense to begin with, but it becomes harder to swing that type of a bill.
And then what is the Fed sort of thought process around what's happened with these rates?
Putting ourselves in Jerome Powell's shoes, an increase in rates of this magnitude that has coincided with expectations for stronger economic growth and increased inflation are not something that the Fed is going to be worried about. Because this, in many ways, you could say that this increase in interest rates is just reflecting a rosier economic outlook and evidence that all of the fiscal and monetary stimulus during COVID is starting to work.
How should we be thinking about this move in terms of equity prices?
We've talked about how the only thing more expensive than stocks are high quality bonds and cash. And that situation can normalize itself either by stocks getting more expensive to get on par with cash and bonds, and that's been happening, or bonds can get cheaper, meaning interest rates would have to increase. And what we've seen the last 2 months is really the first sign of that happening. But the key thing to note is interest rates are still so low after these increases that there still is no alternative. TINA still holds true. We would still need to see a pretty rapid move from here, a pretty big move from here before the 10-year Treasury note yield gets on par with the earnings yield of the S&P 500. We'd need to see interest rates get up above 2% in order for that to happen. So there still is no alternative. Now, we think this is not an existential risk to the market at this point. It's more of a risk within the market, and it accelerates a rotation out of some of those more expensive growth equities into more value equities, which is something we have no problem with.
Yeah. So I guess in other words, just sort of sit back and enjoy the ride and don't expect a lot of bumps in the near term.